Good afternoon, everybody. My name is Mateen Victory, and I'm joined here by my partners Kevin Miri, Andre Damata, Ran Wang, and Ravi Singh. We are Group 8, and we are presenting the Arundel Partners case today. We're going to begin with a case overview, followed by two separate valuation models we prepared today, one being a DCF and the other a real options model. We'll then compare and contrast the two to talk about the pros and cons of each and why we think the options valuation model is a slightly better vehicle, given the unique context of the case. We will also talk about organizational and strategy challenges that we expect could pop up in the face of Arundel trying to implement their business ideas. And finally, some ancillary finance considerations, time permitting. So to begin with setting, we are in 1992 in Los Angeles, and a movie industry analyst has been asked to identify a very unique business opportunity involving the purchase of sequel rights from major US film studios. So the prospective acquirer, which is this consortium of investors called Arundel, looks to purchase sequel rights on a studio's entire production schedule for a specified period before any films are produced in any kind of film series. So this is before the first film has even been produced by the studio. This is an options-based business model in the sense that Arundel waits to see if particular films happen to become successful at the box office and then can exercise its sequel rights and either produce the sequel by itself or sell those rights to the next highest bidder. Meanwhile, if the initial film flops and no sequel would likely be made, they won't exercise the option right. It will expire unused. Now, it's critical that the deal be conducted before the studio even knows what films it will produce. That's to avoid information asymmetry. If the studio starts producing a film and knows it's going to be a good film, or can at least predict as much, it would create an information asymmetry situation in which they could start charging a premium for those sequel rights to be purchased by Arundel. In service of avoiding that, Arundel wanted to get in on the action before the first film was even produced. So not even the studio knew which films it was going to produce. Now, a critical element of the value creation mechanism in this project is the concept of relative comparative advantage. What one party to the transaction lacks, the other supplies, generating a mutually beneficial outcome, because movie making is expensive business. And not only is it expensive, it's actually very risky. It's proven very difficult time and time again to predict the likelihood of commercial success when you're talking about films and film audiences. Studios themselves, furthermore, are not flush with cash whatsoever. They rely heavily on borrowing, and those financial constraints really narrow the creative potential of film studios. Oppositely, Arundel would have significant cash on hand and investment capabilities. So by buying studios' production rights, Arundel offers much needed cash upfront and financial security, reducing their borrowing needs and allowing studios to have greater creative potential. And in exchange, Arundel receives and benefits from the expertise of the US's leading film studios, which have the creative vision, people, capacity, experience, and resources to create blockbuster films. I'm going to hand it over to Kevin to talk about the models we prepared for today.
Thanks, Mateen. So to start off with our traditional NPV or DCF valuation, I wanted to run through our basic inputs first. So with expected cash flow, what we wanted to do here was to account for the unsystematic risk of the project by multiplying the cash flows by a probability metric that represented the probability of success of a sequel. And as will be later shown, we actually used two models to do this. Now, for the discount rate, we started off with the project timeline. We believe the project timeline to be around 4 years because the sequel release was typically 3 years after the first film release. Which gives us 4 years in total. Now, given this project timeline, we went with a US 5-year treasury rate as our risk-free rate to match the project horizon. The market risk premium, we calculated using 40 years worth of both S&P 500 returns and US 5-year treasury returns, giving us a 5.92% market risk premium. And the beta we found using Damodaran's US sector beta data. And we used the entertainment industry because we believed it was a good representation of the systematic risk of the film industry. So as previously mentioned, we used two models. The first model assumes that the success of the first film can be used to predict the success of the second film. We believe this to be accurate because we ran a regression between the IRRs of the first film and the second film, and they were highly statistically significant with a coefficient of around 0.5. So given this, we assumed a 20% hurdle rate for the second film would be deemed a success. Because that's typically the industry norm when it comes to private equity and things of that nature. So we found that the first film would then need to have an IRR of 40% given our regression. We filtered for this and found that 37 first films actually had IRRs of over 40%, which gave us our probability of 37.37%. We averaged the hypothetical cash flows of the sequels for these 37 films to get our average cash flow, multiplied it out to get our expected cash flow. and then subtracted out the outflow of 2.5 million, which was our assumption for the option price in this case, giving us a total NPV of 1.9 million per film on a present value basis. Now, model 2 is same methodology, but different underpinning. Here we assumed that it would be based only on the sequel's hypothetical data. So we looked to net cash inflows. Here we first discounted cash inflows by 1 year to t=3 to bring it to the same place with cash outflows were, because cash outflows come out a year before cash inflows. Netting those two out, we found that only 26 firms had positive net cash inflows for their hypothetical sequels, gave us a probability of 26.26%, and the rest is the exact same as model 1. So to understand how sensitive our output was to our inputs, we ran Monte Carlo simulations using the exact same 3 inputs and the exact same distributions for these 3 inputs. The output was obviously the NPV per film. We found that the range for NPV per film for both models varied quite a bit, from -8 million to 13.9 million for model 1. And so when it came to average cash flow, we found that that was the input that the output was most sensitive to. Average cash flow, we assumed a normal distribution. We had a standard deviation. We wanted a Bell type distribution for average cash flow. Probability, we went with a PERT distribution because we wanted to bound it at the upper and lower ends, so it would be a realistic scenario for us. And then finally, cost of capital, we didn't know the type of distribution, but we had an idea of a maximum, which is typically where triangular distributions are used, which is exactly what we use in this scenario. As you can tell, model 2 also has a great deal of variability and volatility. But again, average cash flow is the thing that the output is most sensitive to, and it is a flaw of the DCF compared to an options valuation, because the DCF doesn't entirely account for the volatility of the cash flows, whereas an options model would, because volatility is actually an input into the Black-Scholes model. But before going into that, I'll pass it over to Rand to actually discuss the options valuation with you all.
We were also tasked to assess whether the average $2 million per sequel right is a good investment using an alternative to the DCF. Arundel's business model is buying sequel rights to original movies before they're even released. The reason is that studios only produce sequels if the originals are successful. So if the studios were to buy the sequel rights before the originals are even released, then they could buy them for cheap. So essentially, Arundel's business model is betting on that some of the original movies will be hits. We can use the Black-Scholes option pricing model because this arrangement is similar to a call option that grants the holder the option to buy the asset. Of course, the holders will only exercise the option if the current stock market price is higher than the exercise price, so that they can sell them on the market for a profit. Parallel to Arundel's case, it will only produce the sequels if the original movie is successful. Why should we use Black-Scholes in addition to DCF? Because only Black-Scholes accounts for management flexibility. In this case, if the original is not successful, then Arundel's management has the flexibility to not produce a sequel to cut further negative cash flows. But DCF doesn't have this feature. Also, Black-Scholes uses the volatility of similar projects. In our case, we use the standard deviations of returns of expected sequels produced in 1989 by 6 major studios. However, the discount rate used in DCF uses the firm's equity beta, which might not appropriately reflect the risk profile of the project. Now, let's take a look at how to use the Black-Scholes model. It has 5 inputs. The first is the stock price. Sequel rights is not an equity stock, so we use the average expected cash inflows of the sequels produced. The second is the exercise or the strike price. Arundel would not exercise its option unless the hypothetical cash flows of the sequel exceeded its expected cost, so we use this figure. The third is the time to maturity. We use 1 year for this because we'll know whether the original movie is successful or not after only 4 or 5 weeks. The fourth is the annual risk-free rate, which is just the 8.26 treasury rate that we used in our DCF earlier for consistency. The last is the annual volatility. We use the standard deviation of returns of expected sequels produced in 1989 by 6 major studios, given in the case. After we determine the inputs, We use the Black-Scholes formula to calculate the option value. We also use a Monte Carlo simulation to consider the ranges of the 5 inputs. The median result of running the simulation is 9.92 million, which is greater than the 2 million average SQL write price. So it's a good investment.
Great. And now I'll be discussing our answers to question 4 and question 5. Question 4 asked us to look at the real option valuation as compared to the DCF valuation to assess if one or the other is superior or if neither are superior. We believe the real option valuation method has a bit of an edge over the DCF valuation in this case because the underlying investment into movie sequels really is an option in its fundamental investment opportunity. So we thought it was more fitting. But ultimately, we conclude that Arundel should use both to determine the true value because they complement each other through their different pros and cons. And as you can see on the screen here, we have the pros and cons of both the DCF valuation and the real option valuation. And we only included those pros and cons that we thought were most important and ranked them accordingly to their importance. So for the DCF, we thought it was really important that we were able to build in very specific investment assumptions given the Arundel opportunity. And what I mean by that is we were able to build in the fact that Arundel would never exercise an option to produce a sequel with negative NPV. And we captured that by, multiplying the cash flows by a probability of what we assumed would be the likelihood that Arundel, one movie, would lead to a successful sequel. So by mitigating that risk, we're more likely to get a closer to real depiction of the true value of the option. And we also thought it was a clearer communication tool, given that NPV is a go or no go decision, and it's very clear for management to implement. But the issues with it was the risk of the opportunity. Arundel's risk, we thought, wasn't truly captured in the CAPM that we use to DCF, and that is inherent in DCF valuation as a whole. And that's because the CAPM assumes that an investor holds a diversified portfolio of different assets. And here it's unlikely that Arundel would hold that much of a diverse portfolio, given that they're only buying from probably a few studios and doing only a few sequels. So very unlikely that the risk is appropriate in this case because the idiosyncratic risk isn't assumed away or shouldn't be assumed away in this case. And there's also a lot of assumptions about the specific movies in terms of the types of movies that we based our evaluations on. The data could be old and it might not be true going forward. And the number of sequels also, it assumed that Arundel would be able to produce 26 sequels in 1 year. And that's very unlikely given that one studio only produced 10, 3 of which were positive NPV. So, and it's unlikely that they'd contract with many more than one studio. On the real option side, we thought a very big pro that the DCF didn't have was the fact that it accounts for volatility, given that the returns of the sequels are very volatile. As you've seen through my colleagues' discussion, volatility is very high in this industry or in this investment opportunity, given that the cash flow can vary widely from a huge success in a sequel to something that isn't very successful. So very good that the real option valuation captures that, which the DCF doesn't. And also very fundamentally, it would be a good tool for the ground operations in terms of the 3 phases that Arundel would go through in terms of getting the sequels actually done. So operational on the ground floor in the different phases, we thought it'd be a very good tool for them to use going forward. And the cons, as I mentioned, the communication is probably not as clear as the DCF, and the estimates we have to use the risk-free rates and volatility, and that might change over time. So that might not be as accurate. And for question 5, we had to look at the organizational and strategic or business challenges. And again, here we thought of the most important and ranked them according to their importance of the organizational challenges and the business challenges. So of this organizational challenges, we thought the most important was the negotiation of the contractual terms with the studio. We think it's very important for them to make sure that in terms of contracting with the studio, that they are able to incentivize the studio to make movies that are able to make sequels, because if they're not able to do that, then there's no value to having an option to make a sequel for movies that can't be done to. And on the business challenges side, we thought the most important, or one of the most important parts was the option pricing, and the fact that we know that the valuation of it is higher than what people in the market might be willing to buy. So if we're able to get a sweet spot in between there and to negotiate with these different studios, that would be obviously a challenge, but something that could work to Arundel's advantage in terms of capturing more value. And given these different challenges, we thought the The important recommendations here would be to include in the option contracts an incentive to motivate studios to produce movies that will lead to sequels. So that could be tied to the revenues of subsequent sequels for the studios, and to contract with studios that have no apparent business or operational issues. We don't want to contract with studios that will go bankrupt or have labor strikes. So want to make sure the due diligence there is done appropriately. Thank you, and I'll pass it over to Kevin.
So to end up, we just wanted to point out some ancillary finance considerations that might add accuracy to our valuation models. The first one is to actually find the expected value of the selling the sequel rights. There wasn't much information in the case, so we had to assume that it was zero for our model. But obviously, as was stated, Arundel does have the opportunity to sell it. So instead of an NPV of zero for that scenario, it might be an actual positive NPV. Two, we believe that the sample of the films provided was inappropriate in a sense because it was rather arbitrary. It was akin to trying to value a firm in an industry by picking a random number of firms from that industry instead of looking at the characteristics of the actual comps. And then finally, kind of to that second point, using a studio-specific valuation might be in the favor of Arundel unless they are looking to invest in enough studios where they're diversifying out the unsystematic risk associated with the studio, which didn't seem to be the case. But given more information about what type of studios they wanted to invest in, the valuation would be able to be more accurate and more akin to the characteristics of the films they're actually looking for. So thank you so much for your time, and we hope you learned something.